I'm going to get started. At the beginning of the year, we talked about how 50 nations representing about 60% of the global population, global GDP, were holding elections. To give you the quick review of it, the cost of living has beaten all incumbents. And whether that's been true here, it's been true in European nations, it's been true around the world. And what we're seeing is that those elections have set the stage for massive changes across the world. We're seeing it in Europe, North America, and South America, where leaders have been booted over cost of living and inflation. I think it's nowhere has been more obvious than in the US, and we're experiencing really a creation of a new world order that's been several years in the making, as we just spoke about with the Putin going uncontested really in his aggressiveness for some time, going back to first time in Crimea, or as Adam highlighted, back to 2009. What we're seeing with this new world order is a really divided world, which will have bigger economic dispersion between the haves and have-nots, and the wealthy nations will continue to get wealthier, and the poor nations will continue to get poorer, and that gap's going to get wider. And so that's setting us up for a real challenging time for politicians, but also for sorting through how you're going to play this in the markets. So today I want to cover three topics: the headwinds and tailwinds for the US dollar, the euro and the European economy, and where we see things going and how to position for 2025 as we head into it. So the headwinds for the dollar are pretty straightforward. We have debt deficit issues. We have the Fed easing. You have the Bank of Japan tightening. All those work against a strong dollar. I think the tailwinds are the fact that we have onshoring picking up again. When we talked about it a couple of years ago, it was really hot. Then it started to slow down. Now it's picking up again. Same with foreign direct investment. And I suspect that the anticipation of President Trump moving back into office and fear of his tariffs is going to push countries to aggressively work with their balance of trade with the US and make them less targets for tariffs. So that is one element that is creating a bit of a tailwind. The fact that the three major economies, the China, ECB, and Bank of England, are all easing at the same time, another tailwind for this dollar strength. Mexico's weakness, overall geopolitical mess, the idea of tariffs coming in, and then the deep structural problems facing many emerging market economies all work to support the dollar. And we've seen that where the dollar is focused on a lot of gains for quite some time. And then you had the back and forth about who's going to be the new Treasury Secretary, what's the issues with Powell, all that are starting to impact where we are. But the dollar is really the driver, and it's going to be something that was going to be with us for some time. A big part of it, as I mentioned, is foreign direct investments. And we've seen that really continue to be strong for the US since the initial Trump administration, dropped a little bit with the Biden administration, and I expect will start picking up again, really as a way for countries to offset the potential tariffs that might come their way. And as we get into next slide, I'm going to talk about Scott Besson as his nomination for Treasury Secretary. But his view of tariffs are escalate to de-escalate, meaning he views it more as a negotiating approach. So let's talk about Scott and his 3-3-3 plan and what his focus is and what his opportunities are to succeed if he is appointed as the Secretary of Treasury. And let me start by saying that while many of the several of the candidates that President Trump has appointed for his cabinet that have to go through Congress would not necessarily meet the traditional snuff test for cabinet appointments. One dropped out already. There'll probably be a couple that will be contested, but I think what Trump did in his selection of the Treasury Secretary was really focusing on the thing that really matters to him in terms of how he will evaluate his legacy. Is a lot of it will be market driven. So I think with Scott Besson, he's getting somebody who is a market kind of guy with a deep understanding of history, a deep understanding of the interdependencies and interconnectivity of the global economy, which is a real more of a market-oriented approach, which I think is part of the reason you saw Treasury yields drop so aggressively yesterday prior to the Trump announcement of his tariff plans. It's also why I think the markets have been a little bit more positive lately, is because of the view that we have somebody who understands the dynamics and that it can't go too far. So his plan basically is, his focus is going to be extending the tax cuts and putting through some of the other tax changes that the president would like. I don't believe it's going to be, he's going to be able to get lowering corporate taxes at all. I think what he'll be able to do is get an extension of the tax cuts, throw in a couple bonuses like maybe Social Security, not Social Security, but maybe tips for workers to be exempt, but he's not going to get through the full policy. I think on the trade side, it's going to be really interesting to see whether the trade policies put him at odds, or his approach to it puts him at odds with President Trump, who, as you know, is known for temper tantrums and if things aren't going exactly his way. But the plan is really what got him the role is his 3-3-3 plan, which is targeting 3% economic growth, which he believes we could get through selective use of tariffs, through lowering energy costs, and through reducing regulation, which is a big part of the Trump program and platform. The idea will be to reduce the budget deficit from its current 6% to around 3%, and then to increase oil production or its equivalents by 3 million barrels a day. I think each of these is a tough task. Washington is probably going to be okay with the selection of him in terms of Congress. Wall Street seems to like the selection. The real question is, will he be able to thread the needle? I think his candidacy is probably a good one because conservatives and progressives don't love the selection. But I think his task at hand is going to be quite challenging, as William Dudley suggested. Former Fed president of the New York Fed, in an op-ed yesterday, said there's 4 steps that Besson needs to take to be successful. First one is stress fiscal prudence to avoid higher debt servicing costs. Second is to broaden the tax base to ensure everyone pays what they owe. Third is to be realistic about the revenue and impact on tariffs on the economy. And the fourth is to support the Fed independence, which is critical going forward. I think he has a big task ahead, but I feel more comfortable with his selection than some of the names that were being bandied around. So that's kind of the things that are driving the U.S. strength are really, we have a very strong economy. The dollar is a safe haven, and in times of global stress, we can't tend to suck in a lot of capital. Plus, we have a pretty significant yield differential over most of the advanced economies, which will continue well into the future. In our view, is the economy is so strong that the Fed does not need to aggressively cut, and probably has been too aggressive with their 75 basis point cuts to date. So switching to Europe, Europe has a big problem. We've talked about this for some time. Christine Lagarde was out the other day with this comment. She thinks the problems are deep. The need to move is immediate. And if not change coming very quickly, the compounding of the problems will accelerate, whether it's security, climate change, protecting the environment, or meeting their population's needs. So in her mind, there needs to be a very significant shift into how we move forward, and we'll touch on that in a minute. So here's the euro. It's dropping to the lowest levels in some time, and will continue to, in our view, move that way because of the embedded problems in the euro. I think you're seeing private sector activity contracting pretty significantly, both in the services and manufacturing PMI. That is the sign of a continued weakness in the corporate sector as well. The reasons for that are clear. A big part of it is around their energy prices and the competitive disadvantages that Europe is at as a result of this. And I think what this is leading to is industries dying, global market leaders losing share, companies aggressively laying off people, and the private sector continuing to contract. You saw that with workers at Volkswagen plants preparing to strike because they are looking at factory closures. Ford is cutting 4,000 European jobs. You've seen ThyssenKrupp announcing 5,000 layoffs and I think 6,000 contract workers, which would result in about 40% of their combined labor force. So there are real problems underlying the industries in Europe. But I think one of the big issues is energy prices. And let me put this in perspective. I think the problem with energy in Europe is a result of bad policy, bad leadership, and a focus on ideology over practical solutions as they were making the energy transition. But to put it in perspective, German households' electrical prices are 2.7 times that of the US, 2.5 times that of China. German businesses pay 1.7 times those of their US competitors and 2.8 times those of their China competitors. Its renewable energy is about 5 times the cost of conventional, and renewables have grown since 2006 when it peaked, but energy consumption is down 17% because the cost misalignment is so great there. So I think this is the Achilles heel right now that is hurting the European economy. And when you think about the spending needs that Lagarde has mentioned, whether it's on defense spending, whether it's on innovation, whether it's on propping up the capital markets, deepening the capital market system, there's a real issue here. We'll touch on her solutions in a minute. But part of the reason that capital is going to continue to flow out of Europe and into the US is the yield differentials. And as the US slows its rate cuts, Europe is looking at pretty steady rate cuts to help support the economy. You're looking at over 230 basis points of yield differential between the two as of the other day. That's come in a little bit, but it gives you a sense of the struggles there. So I think the US has 5 long-term advantages over Europe that we need to really pay attention to. We're much less reliant on old economy industries, and Europe's leaders have been in secular decline for some time. Lagarde believes that Europe needs to change. They need to invest and they need to innovate rather than just regulate. And I think that's one of the big issues. We just touched on the energy issue. US is going to be one of the largest energy exporters. We are one of the largest energy producers right now, if not the largest. And you could safe to say that the growth of fracking in the US and shale in the US has changed the energy dynamics for the foreseeable future. And Europe just got caught on the wrong end of that. I think Europe's role in finance is one that they're struggling with, and that's because of the inability to realize the scale of being the largest market in the world, but a fragmented market with individual nations' banking systems continuing to weaken, and the approach that the euro took coming out of the financial crisis was not one that provided long-term stability in the system. And they're still dealing with the structural flaws of the original design. We'll touch on that in a minute. I think demographics continue to work against it. And to put that in perspective, the US is probably the only major developed economy that is projected to have its workforce maintain the same level over the next decade or two, where Europe is continuing to struggle. The rest of the developed nations are continuing to struggle with demographic issues, with labor supply issues and availability, and immigration issues, which are going to be essential to solving that problem. So I think those are some of the issues. And lastly, we're working to reduce regulation while Europe has been increasing regulation. And that is crippling a lot of the a lot of the European companies and forcing them to look at other options where they're going to go. So Lagarde has a solution for Europe that she talked about in a speech yesterday. And it starts with moving away from the model that they've had, which is bottom-up harmonization, to a top-down integration, which will mean the creation of a capital markets union for Europe, to counter the rest of the world and for Europe, and to prevent Europe from becoming even more fragmented. Europe also needs to save less. Europeans are big savers and light investors. So if you look at most European nations, their savings rates are very high, but their investment rates are very low, which means that they're missing that element from feeding the capital market system, particularly the growth of business and innovation. I think innovation is blocked, according to Lagarde, in 3 areas. Entering, when you have such high savings rates in low-yielding deposits instead of the capital markets, you're actually holding back the economy from moving forward because you're having low return and low growth through that. That's number one. Number two is they have to expand. When savings shifts to investments, you start to feed areas, and this is one of the reasons the European venture community is so slow. When it stays in savings, you're not getting these startups going, which you're not getting the follow through, which then pushes the public markets as well. So I think that's the second thing. And then expanding, they need to keep it inside Europe, but out beyond the nation's borders that it tends to stay in. So Europe tends to support its own nations, but not support the European economy very well. And that leads to a stifling of innovation. And I think these are the issues that Europe's been struggling with. And then what you end up with is very few high growth companies with lower valuations and lower liquidity in the markets. So it's very hard to, grow wealth. So when you think about the impacts on Europe, they've had less wealth accumulation as well as less corporate growth. And just to put that in perspective, since 2009, U.S. household wealth has grown 3 times more than that of European households. So that gives you a sense of the challenges and the discrepancies. And to me, it goes back to bad policy, bad leadership, and a bad structure that the European Union was founded on, that Lagarde is suggesting you need to get past, which would require more integration rather than less. And that is going to be a tall task given the rise in nationalism that you're seeing in Europe. So in our view of the world right now, higher costs are sinking incumbents in elections around the world. That's going to continue, and the push to lower costs is going to be very strong for leaders, but it's going to be a big challenge. I think countries are looking at ways right now to ease the imbalances that they have so that they can be on the right side of tariffs and create a competitive advantage. But they're also looking how they have to play US versus China. And I think countries like India are playing it exceptionally well. But we are in a world with low growth expectations, with rising debt levels. And that means we're going to have even bigger divergences, because if you can't grow and you're saddled with big debts and you're not innovating, you're going to be left behind. And those debts are going to rise and going to lead to greater strains, and internally going to lead to greater social unrest, which leads to more leadership change. And that ultimately leads to less effective spending by governments at a time that their fiscal bandwidth is limited. I think the bond markets could be the savior for the US and for many economies around the world, which they're already starting to show concerns about deficits and debt levels. And I think that is going to be one of the regulators, and having somebody like Besson as the US Treasury Secretary, I think will help, because he truly understands, I believe, the challenges that exist in the debt markets and with deficits, and will act as somewhat of a regulator on the impulses of the incoming president. We're still focused on the areas we've liked all along: tech, materials, industrial, and defense. I think the challenge right now, and energy as well, some financials. I think the challenge right now is a lot of the favored names are getting a little long in the tooth, and finding new names to replace them is going to be paramount. And because the venture world is not graduating into the public markets the way it used to, small caps are struggling a little bit more, although they are starting to pick up, and you are seeing a broadening out. I think one of the interesting things about deregulation that we'll touch on is in a deregulated environment, in the US, mid caps, companies under 500 employees or less, will tend to get the biggest benefit of deregulation. Large caps have the money to spend regardless of the levels of regulation, so it's less of an issue for them. Small caps don't necessarily have the cash, so it won't matter either way. But mid caps could be big beneficiaries of deregulation. So we still think that the US will continue to attract capital in this type of environment from the rest of the world because of the challenges that exist. So Mark covered a lot. I'm going to stop there and open up for comments.
Very good. Adam's quick. Hey, Adam.
Good morning, Mark and Stephen. Thank you for the presentation, Stephen. My question is about European energy and Lagarde's plan in addressing that. Since the second invasion, with the cutoff of Gazprom gas into Europe, Germany in particular was hit hardest. So the landscape of energy in Europe differs. The US is now the largest exporter of LNG gas to Europe. And most of the pipeline gas now, particularly into Germany, comes out of Norway. And there's a huge cost difference of that gas, that energy, compared to what they were getting from Russia. So my question is, what is her plan in terms of that? Have you seen anything in detail about that?
No, I don't.
That's my question.
She's not executing a plan. She's actually laying out pretty much the same thing that Draghi laid out with his recommendations. Europe has to change the way they're operating. They can't continue to be, a bunch of individual countries trying to act as a union and getting none of the benefits from it. So they have to come up with a European solution, which is going to be very difficult at a time where nationalism is rising. So I think she's highlighting the problems. How you get a solution for this, I think, is why you're going to continue to see capital leave there and come to the US, because it's going to, and to other areas, because it's going to be very hard to make that transition because they're several years too late.
Yeah. Thank you, Stephen.
You're welcome. I do think there's one thing that everyone needs to really focus on. It's comments out of Germany about changing the fiscal limits, and Merkel backing Merz on that with her comments yesterday. She's the one who put a lot of those breaks in on the fiscal breaks, where I think the number is they're not supposed to go over 0.35% of GDP as the deficits, and I think she's working on correcting that. I think they need to have some relief from that area to get the investments that they need to help solve some of these problems.
So Maria, as a neighbor to Germany of sorts.
Yeah, Swedish citizen. Thank you, Mr. Burke. I really appreciate this presentation. As a Swedish citizen and growing up in Sweden, I could just confirm what you're saying, that we are, the nationalism is thriving more and more. I would say like a third of the population in general in the Western world is very nationalistic, and so we're sort of regressing, holding on to what we believe is our core identification, and also the war that is going on, it's scary. So people are holding back to investments, and because of that reason. And we have seen wars going on in Europe for many years, and you haven't really felt that here in America. So I'm saying here because I'm in New York now, but yeah, I think and the nationalists will make it difficult. So I don't know the way forward, but I just want to confirm. And the spending, how we're holding back, is very very much speaking of the lack of optimism. Thank you.
And it's creating a self-reinforcing problem, is that if they keep being nationalistic, they're going to have the problems internally that they're trying to avoid, but they're just going to continue to grow because there isn't going to be enough growth in Europe. I mean, they're projected to grow around less than 1% next year. It is really hard to solve the problems that they have and meet the spending needs of the population without the growth. And they're doing everything they can, it seems, to prevent the growth that's required to move forward. It's a fascinating study in what not to do to try and solve a problem.
So Michael Hammer?
Going back to your slide on Scott Besson and 333.
Yep.
Getting to a 3% deficit is essentially cutting it in half. And so the real question is going to be how quickly, right? So is it over 4 years? Is it over 2 years? As Musk seems to want to slash and burn. And then he's also dealing with other Trump constituencies and appointees who are going to make his job incredibly difficult. And I think threading the needle is understating it, if you will.
Fair enough. I wouldn't argue with you on any of those points. Starting with the Commerce Secretary, who wanted the same job as an adversary as opposed to a partner, I think is realistic. It's not an easy task. I think what's going to help him in his role is the fact that I believe that President Trump will care as much about how the market does as any president in history. And I think the market policies, I think that's going to lead him to pull back from his worst instincts and give Besson a little bit more support. But it is possible that he's Gary Cohn, as Gary Cohn was in the last administration, and leaves very quickly because it's just not practical to work in that environment. And that would be a worry if we start to see that kind of revolving door.
The other comment I'll make is, I think we should all remember that historically, Donald Trump has liked debt. He's liked leverage. And so it'll be interesting to see how that plays out in his second administration.
I agree. But I don't think he's going to want to be the president who won on cost of living and then lost for the party on cost of living in the next round. I think he wants his legacy to be he's great, not he didn't deliver. So I think that's where Besson and the selection of Besson was encouraging to me, not a solution, but an encouraging move compared to some of the other selections that were made.
But looking great in the short term is not this, it doesn't equate to long-term stability and good outcomes. In other words,
No.
you can game the system for the short term.
Yeah, the market's already is pretty aware of what's going on. If you think about it, the rates moved up 70 basis points or so since the election. So I think that was a bit of a message. It dropped quickly yesterday, 13 basis points yesterday on the 10-year. And then as soon as Trump made his announcement, it gave back some of that. So I think that's what we're going to be dealing with. And I think, Michael, you bring up great points. I think the real issue is be prepared for intraday volatility from off-the-cuff comments that will be disruptive throughout the next 4 years for investors.
Whiplash.
Yeah, you have to have a strategy and you got to stick to your strategy and be prepared for the changes that are coming with him.
Paul? First, and then Anthony?
Hey, Stephen. Hey, I posted the GDP differences over the last 20 years for the US and EU in the chat. So US is just under 3 times increase, or 3x 3 times the 2003 versus EU is about 1.85 times the 2003. And the biggest difference you see is the only difference that from that growth is the lack of the mega tech companies like Amazon, Meta, Google, Apple, etc. And what is the EU doing to make up the difference? Like, me in college in the 90s, like there were all these great European tech companies, Siemens and BASF and many others that ST Electronics. I remember all these tech, Philips, all these great tech companies were in Europe, and you don't hear, at least I don't hear the same, kind of like they don't have these great tech names that you think of when you think of European tech companies. And then is that the only difference? And the other question is, what are they doing to like make up the difference now? Like in the AI boom or other kind of, they have Novo Nordisk, there's maybe some French AI companies, but it seems like they may be missing the boat again. Like they don't have the same VC funding effort. They don't have the same attitude towards failure. They don't have, they have more regulations. They are disjointed because there's multiple jurisdictions to deal with when you're building kind of tech companies. Like what do you see them doing, if anything, to kind of like try to make up the difference for the next wave of technology?
I think the differences to me are there's four or five major areas that are creating the problems. One is, as you highlighted, the US is very much a new economy versus old economy that Europe is in terms of our industries. So that's one. Clearly, the culture of innovation that you've highlighted. And even inside the US, I'm a New Yorker. I didn't fully appreciate it until I started spending more time in the Valley and seeing just how different the mindset is there versus New York. So compare that to Europe, and I think you have a very significant mindset difference there. I think coming out of the financial crisis, the way Europe solved their banking problem versus the way the US did with recapping the banks left the European banks weaker and the US banks stronger. So I think that has played through in terms of how funding the economy has flown, how credit and capital has moved around. We touched on the savings rate. I think that's all part and parcel to that. I think the third area is industrial policy. The US was very aggressive on industrial policy, and Europe has not been. They do it on a country basis, which doesn't give them the scale that the US might get for those countries that could afford to do it. And then the fourth is regulation. The views of regulation and the focus on regulation are very different. And the fifth thing is having the energy to do it at a lower cost matters. So add to that the demographic cliff. And I think all the disadvantages that I talked about are the advantage of the US over Europe are all play into it. And I think that the last thing I'd say is I think the leaders failed. I just think the leadership of Europe failed their populations. I think Merkel stayed too long with Russia. They were fighting internally more than they should. France and Germany should be leading instead of not. They create pockets and silos of opportunities where they don't get the scale. And there is just not enough entrepreneurial spirit being promoted there. So too much savings and not enough investment all play into it. So I think those are the things. And I don't think there's a quick answer to any of this. I do think loosening the fiscal restraints on governments is one, but they need to decide they want to have European champions instead of country champions if they're going to succeed. And that's going to be very difficult with nationalism rising, as Maria had mentioned earlier. So how do you compete against, Raytheon or, Google or any of the big US industry leaders when you're, not getting support of your own region? It's very difficult. So I think those are the issues, not a quick solution, and it needs a big mindset change, and it needs the leaders there to lead. And that means the biggest countries have to step up and do the right thing. And it's going to be very hard since Germany doesn't have a leader right now in Europe, and France is in a similar sloppy state. So Maria, you want to add to that?
Yeah, and I believe the way forward is actually how we go from a nation-centric thinking where we have, you know, foundations from a couple of hundred years back, the legal system and the political system, and moving onwards to a global local world. And it needs to be both, because to look at only to how we create a global world and ignoring which is the nationalistic streams, like what about us, what about me, what about, so it needs to be embraced both, and that's what I'm working on.
Thank you.
Anthony you still have a comment before Andrew?
Yeah, Mark, subsequent to my question, I have a couple of comments, but I also have a question. Can I talk about the comments? What's the question?
Go for it.
So, my question, Steve, was on what your thoughts were on NLS on, you know, we see the DAX, which is in 10 years relatively about half and absolutely about half the performance of the S&P in terms of pure growth. But the DAX makes, you know, is making new highs. I think all of us on this call would prefer to think of ourselves as snipers, and so we don't buy indexes or, you know, broad-based ideas. We all look for the particular, and obviously within the DAX there's a whole mixture of things. But you know, that is something I ask every day. Like, how I agree with everything you said about the constraints and the restraints and all of that that's going on over there in Europe, but the markets are, you know, climbing this wall of worry. The DAX is at what, like 15 PE, which relative to the S&P is kind of reasonable. So my question was, do you have thoughts on that? And then my comments were, there are exceptions everywhere. I mean, without ASML, there is no AI, and ASML is Dutch, and its sister that no one knows about, which is ASM, is also Dutch. And then you have NXP and Dassault and Infinium and Accenture and SAP. If you ask anyone that uses SAP, they moan and they complain and they talk about geriatrics, but it's at all-time highs, and people seem to be unable to disconnect from SAP. So SAP is German. You see Volkswagen, which I think is a metaphor for everything you said, you know, rotting and collapsing into pure dismay. And I think that's a wake up for everyone at the helm there, that you've got to do something before it's too late, because Volkswagen seems that it's, you know, irrecoverable in terms of its, what I would almost call a collapse. But to say that Europe is gone, done and dusted is untrue. And you're not saying that, but there's certain companies that are irreplaceable, such as LVMH, Hermes. You look at the Swiss On that are taking on Nike and, you know, Hoka and the rest of the world, the shoes. So there is dynamism there. And obviously another one is the Inditex, which is Spain, the Zara, Ortega, Rolls-Royce out of the UK, Amadeus, which runs the whole booking tech infrastructure.
And Anthony, did you look like you're making the case pretty strongly here for spotted snipering. But what do you think of macro?
Well, that's my question to Stephen, because yeah, the macro sucks, and that's the, you know, that's the thing. Like, how do you, and believe me, those people would probably, all those people I mentioned would probably rather be based in the US right now for all the reasons, but they're not. They're based there. Well, the Dutch like the tax advantages, but so what do you, and Accenture likes the, you know, the tax and so on and so on, and you know all about that. But what is this? When does it break? In other words, you know, what you, when you hear you talk, Stephen, you think of like the collapse, like Volkswagen, but it's not happening. So why is it not happening? Is it happening because Volkswagen's down and SAP's up? Is it happening because there's some nepotism in that potentially asset managers, particularly if they're European based, feel like they have an allegiance to buy European stocks? And I don't know the answer. That's why I'm throwing it up. What's going on?
I think you have a market that carries a low valuation that deserves every bit of it because it's lacking the innovation that's required. I agree with you that there are a number of unbelievably outstanding and essential companies in Europe, but I think Europe has a growth problem that they're not going to solve. They have a debt problem that is very difficult to deal with, and their structure makes it very difficult for them to move forward. That doesn't mean it's a total collapse. It just means that it's hard to get the kind of investment opportunities broadly that are going to push the economy forward and solve the underlying problems of employment, of the lack of how they're addressing cost of living, how they're addressing living standards, how they're dealing with all the social issues that they're trying to solve for, and how do they pay for the subsidies that are so prevalent in Europe that the population loves to keep moving. So I think you're 100% right. You can find good stocks there. I think it's going to be very hard to see the economies of Europe move forward. And I think that's going to continue to have capital flow out of Europe to other areas. So I think you're 100% right. I agree with you on all your cases. I just don't think that Europe itself can move forward. And I think the reason it's not in total collapse is it's doing just enough to get by. Because if it was really in a collapse, then none of the people would be, the incumbents would all be wiped out, not even being considered to be part of the governments going forward. So I think it's really an issue of they're just not doing enough, and they keep creating solutions to old problems that aren't the right ones because they don't put enough money to it. I think they need a big bang there, and I don't think they're going to get it. I think that's why you have this stall speed that's going on.
I just want to add one thing quickly. I think part of it is a religious cultural thing because there's a lot of glue within each country and they're not willing to give up that glue and really flow. There's still nationalism between, if you're Greece, France, Spain, it's really high. And with whatever we have going on here, this so-called melting pot is very accretive to like, hey, get out, go and do it, make it happen. And it's a lot harder to do that there. So if you're I left out Novo Nordisk, but if you're Novo Nordisk, you're a god in Denmark. But if you want to start, by the way, Joe and the Juice, which is now General Atlantic, that started as a store in Copenhagen, right? And then it got, it grew and the Danish guys backed it and so on. But it's a lot harder. My point is for Joe and the Juice to make it big time and to land on Madison Avenue and have General Atlantic buy them, it's a much harder hurdle than if you're a guy in Pittsburgh and you start, a new juice company. And that's probably not going to change because I don't know what the right word, whether it's pride, nationalism, religion, it's instilled in people from the day they go to school.
I could listen to Anthony all day, but I have 4 other hands up. But we'll have to talk about this, Anthony. I think we should bring some of those champions together and hear more. But I don't feel a sense of urgency. You can hear it from Macron a little bit. But Andrew.
Thanks, Mark. Thanks, Stephen. Given the run-up in the crypto market, I was wondering if you could speak to, or anybody else on the call, perhaps what is Europe's appetite and interest in the crypto market? Does that enter the fray in asset allocation? And maybe as a second question, what do you attribute the run-up in crypto to currently?
What? I would defer to anybody who knows anything about crypto because it's not me, other than I missed it because I don't know how to value it. I attribute the run up to things that, from my understanding, and if Bill Deukler's still on, he's not on me. But I think the idea was that it was going to be running up anyway, and then Trump just poured gasoline all over the fire on it. So I think that's really. I think it's that simple, but I'll leave it to anyone else who really understands crypto.
I don't mind answering if you wish.
Go, please.
Andrew, why is crypto going up now? It's very similar to why crops bloom in the summer, right? There is a 4-year cycle, and in crypto we call it summer and winter, spring and fall, let's say. We had a winter. What defines the apex of the winter, right, is the halving, in which you do the same amount of work, but you get half the reward. So you get half the amount of units of production, but the units of production become more valuable. Thus, you don't mind doing more work because the units of production decrease, but the unit value increases. So it is whilst it's supposed to be, or theoretically, a 4-year cycle, it is in fact more along the lines of a 3-year, 10-month cycle. What is sort of unusual about the rally is that the first cycle happened sort of, let's say, right after the election in 2008. Then it happened around the time of the election in 2012. It happened a little like in the summer of 2016, late fall of 2016, in the summer of 2020, and in the spring of 2024. So what was slightly unusual, it's a little bit like a spring. It sort of coiled up, but did not unleash. It stayed coiled up or stayed in a trading range for a long period of time.
Giovanni, what do you see it going?
Where do I see it going? There is two arguments, right? There is more financialization of Bitcoin. So Bitcoin well, not just Bitcoin ETFs, but more importantly, options and derivatives. So the capital that's flowing into Bitcoin has more places to go into. So 8 years ago, there were more sort of shit coins. So, altcoins. So capital is flowing there. If this capital remains relatively restricted because of Bitcoin ETFs, then I see that Bitcoin could easily surpass 2,000, sort of 300,000. But more importantly, it's not a sort of binary question. You should look at this more like a sort of bell curve, right? So within one standard deviation from the last high was 65,000 in the last cycle, there is a at least 2 standard deviation probability, so greater than 85% probability that Bitcoin will double. It will probably triple. So that's a one standard deviation. It's mean.
Are you coming to New York on December 3rd?
I'm not planning on it, no.
Okay. Because we could continue with that. I've got other hands, and I was just mindful that some people really don't care about Bitcoin.
Okay.
But we'll continue.
Okay.
Samir.
Yeah, thank you. So a question I had is about subsidies, right? So I think Steve, you had mentioned Europe has lots of subsidies, which it does, but the US has plenty of subsidies as well, right? So we subsidize oil and gas a whole lot. We subsidize pharmaceuticals a whole lot. We subsidize, many industries. We happen to have a more favorable, demographic, I think, equation. And what I've seen consistently across the US and Europe is just much more willingness to invest into innovative ideas here. So I think that's really our differentiator, right? But I would say that there's plenty of inefficiency, right, in the US system. And, if, let's say, the incoming administration is able to resolve some of that, my fear in that when they create this improved government efficiency, that it'll inevitably lead to more inequality, right? That's what tends to happen in such cases. But so I think the question is, okay, how we use subsidies, right? I think big ag in the US is subsidized enormously, the same way that big ag is subsidized in Europe. So I don't think it's about subsidies per se. I think it's about, I'd say it's about other things.
Steven?
I agree. One on the inequality growing because of policies that are being put in place right now. I 100% agree with you on that. I think the subsidies are one of the areas that Musk and Ramaswamy are going to go after pretty aggressively, particularly the ones that favor the rich. And that sounds counterintuitive because of the way the US works, but I actually think there is an element inside with Vance where he's going to look at providing some things for families that that may surprise people. So I think subsidies are going to be a target, but I think there's going to be there's definitely going to, I think they're going to be targeted, but I think they'll still be favored groups coming out of this. That's the way every administration works. So, but we have a lot of fat that we can trim. And the more I've been reading up on the what you could take out of government, I don't think they're going to hit the numbers by any stretch, but I do think that I think there are opportunities to create efficiencies and to right-size areas that will be meaningful. And I think that'll help get us part of the way to some of the money they need to find. I don't think they'll be able to fund the tax cuts that Trump originally proposed, which is why I think extension of the tax cuts will be the best outcome for him. I'm
So
not sure who's up next, Mark Allen.
Alan's been patient.
Thank you. Two things. One, I just want to talk about Anthony's prior comments with the companies in Europe. And I think what you have to look at is where these companies stand in the value chain. ASML, he pointed out, one of the largest companies in Europe by market cap. Yeah, they're doing around 30 billion in revenue. They sell into TSMC, who's doing 75 billion in revenue. And TSMC's biggest customer is Apple, who does 390 billion in revenue, 13x that of ASML. And you look at the margins too, where they're coming out, with where Apple comes out on that. And so I think that just shows you kind of that value in food chain is, you put that in perspective of where they are. The second thing about subsidies, I think it's a really interesting question. For 30 years, we've let China absorb inflation, the global inflation of the world. And now you have Trump saying he wants to go to 100%, tariffs, 25% in Mexico. We've really been pushing this off into other countries, that inflationary component. And, if we think we're going to bring down interest rates, it's going to be interesting to see as people's arms start expiring and moving into real estate, which are people's largest investments right now. That is a debt bomb that is going to be a huge problem. What we're creating is the largest tax for the lower income families. The other tax, which I think is interesting from subsidies, is the Inflation Reduction Act. If you look at 70% of the subsidies, well, I'll call it tax credits, have been provided from the Inflation Reduction Act. They've been to homes for 100,000 and above. That is $5.5 billion that have been provided as a tax benefit to those homes. And this is coming from a guy from Kansas who's very conservative. And so the bottom 25% of the population, again, is getting 2 billion, and the top, 75% getting 5.5 billion. What we're creating is a bifurcated society of energy. And that top, part of the society is getting solar. They're going off grid. They're not having to pay the electrical bills. And, as these electrical companies, I look at PG&E here in California, our prices are increasing every year. Those price increases are going to be pushed on to those lower income individuals who can't get off grid. And that is something that's not being discussed yet, but it's going to become a huge problem in this country moving forward because it is a tax on the lower income families. Anyway, would love to hear people's thoughts. Thanks.
I would just say one thing on that. I do believe that the Trump administration's energy policy is going to shift from government all in on renewables to government all in on US energy to lower the cost. And I think the lowering the cost for energy and lowering the costs for regulation actually does help the low-end consumers because small and medium-sized businesses benefit the most, and they account for 82% of the employment in the US. So if you lower the cost for them and lower their operating costs, you give them more money to hire and more money to pay wages, and that will help the system. Right now, those companies were getting choked off from new hires and wage increases because of crippling energy costs and crippling regulation. So if they can be effective on those two and do it in a way that don't create massive harm, because that's the purpose of regulation is to protect people. If they do it right, I think there is a big opportunity to help solve some of the problem you just highlighted, Alan. But you got to be.
Rob,
Thank you.
Rob, you want to bring us home?
Thanks. Just very briefly, Steve, quick thoughts on this with Netanyahu and the war criminal charge and exploration, and then you were talking Europe earlier. I'm not sure if you said earlier with respect to the increased Ukrainian defense and longer range missile. Were you surprised at either of those actions here pre new transition to presidency?
Well, I'll start with the second one first. I think as was said in the pre-call, I think we waited too long to give Ukraine what they needed a while ago. Both the US and Europe have been too afraid of Putin when Putin's shown what you're dealing with, so you can't pull back. So I think that was a mistake. Your first question again, I'm sorry, I should have written it
With
down.
Netanyahu.
Oh, Netanyahu. I think that is a major problem for the US government. I think the US is caught between a rock and a hard place on that, because if we don't support the ICC, then we're saying that Putin shouldn't be up on charges either. That puts us in a really awkward spot, and Trump doesn't have much regard for multilateral organizations to begin with. So I think that's going to be a real challenge for the administration going forward. I don't know what the answer is. I just know it's going to be a challenge.
Thank you.
Thank you.
Well,
Yeah, we keep creating bigger challenges, Mark, as we go along here.
Mark,
yes.
have a quick statement comment on the Bitcoin question.
All right.
So last week, a Republican senator that's in charge of digital at the US government since this current administration explained that the US government on television, explained that the US government does have Bitcoin. I think it has, well, I won't go into the details, but it has from confiscation. She said that they could increase that substantially. The commentator interview said, well, how do you do that? Do you go and swap? Do you go and buy it? She said, not at all. She said, we have dollar and gold reserves. We can swap those for Bitcoin. So unequivocally, that's what she said. So what does that mean for the tail or headwind of Bitcoin? I won't answer it. I'm just throwing the question out. The next thing I wanted to add is that when you compare Europe and the US, Europe was far more hot and keen and open to allowing digital blockchain and the equivalent vehicles for institutional and retail high net worth investors to access through private and public funds, ETFs, etc. It was only in the February, March of this year that with Gensler and so on, that it was democratized, where the ETFs came to fruition. But these were long-standing in the UK, in Sweden, in Swiss, and other parts of Europe. So to Stephen's point, that the average is very constrained in Europe, but there are exceptions that have gravitated towards that. And the last thing I'll say, from the research I've done, there seems to be a larger network of intelligent GPs that have created funds that address blockchain and, in fact, crypto, that are based in UK, Swiss, and other parts of Europe, more so than in the US.